Professor NamYong Lee's column, Long in Korea. Today, it is not a housing price decline, but the collapse of the asset class system. An error in perspective is amplifying the confusion in Korean society. Many people interpret falling housing prices as a normal economic cycle. However, I judge this not as a simple price correction, but as a restructuring of the social order. What is happening now is not a fluctuation in the asset market, but the dismantling of a class hierarchy formed around asset ownership. In other words, this is not a price issue, but a social contract issue. Over the past 30 years, Korean society has shifted from a labor income society to an asset income society. Statistically, real estate accounts for about 75% of household assets, while financial assets account for about 25%. As a result, economic status has been determined not by occupation, but by asset ownership. That foundation is now collapsing. In international comparison, Korea's structural peculiarity becomes clearer. The OECD average share of financial assets is about 45%, and in the United States about 70%, whereas Korea remains near 25%. This means the national economy has grown not on productivity, but on collateral value. Korea's price-to-income ratio in Seoul is about 18 times, more than double the advanced economy average of about 6 to 8. Such a structure cannot be sustained without continuous price inflation. Globally, real estate prices move with population and productivity. Korea's labor productivity growth declined from around 3% in the 2000s to about 1% recently. At the same time, the fertility rate fell from 1.48 in 2000 to about 0.7. The working age population peaked in 2017 at about 37.6 million and has begun to decline. Demand itself is shrinking. Therefore, this is not a price adjustment, but a reset of the pricing system. The formation and collapse mechanism of the asset class society must be understood. Korea's asset hierarchy was built on leverage. Household debt stands at about 1.9 quadrillion won, around 105% of GDP, far above the OECD average of about 65%. This represents not accumulated wealth but purchasing power pulled from future income. Social class has been created by pledging future labor. When interest rates rise, the class system collapses. In the past, housing prices rose about 5 to 7% annually, while loan rates were around 2 to 3%. Recently, loan rates are near 5%, while price growth is zero or negative. This is negative leverage. Over time, net assets shrink and debt gaps, rather than asset gaps, reorganize social hierarchy. Research by the Bank for International Settlements shows that when household debt exceeds 90% of GDP, potential growth falls by 0.3 to 0.5 percentage points. Korea has already crossed that threshold. Even if asset prices are maintained, economic growth becomes difficult. Policies that defend prices weaken economic vitality. The disappearance of demand stems from demographics. Korea's population peaked around 51.8 million in 2020 and has begun declining. The working age population is expected to fall about 35% by 2045. Housing demand is structurally shrinking. Aging creates structural selling pressure. The share of people over 65 will rise from about 18% today to about 33% by 2040. Retirees must convert assets into consumption, while home purchases among households under 30 have fallen to half the level of 10 years ago. Sellers increase and buyers decrease. Japan experienced this over 30 years, but Korea is aging twice as fast, implying faster adjustment. Real estate is the core collateral of the financial system. About 70% of household bank lending is mortgage-related. Therefore, housing prices directly affect financial stability. Macroprudential policy globally targets risk, not prices. LTV and DSR regulations are financial stability devices, not economic stimulus tools. Korea suppressed prices for years, accumulating volatility. The current decline is the release of that volatility. From an enterprise architecture perspective, housing combines finance, taxation, welfare, labor, and demographics. A single policy cannot solve it. Class collapse changes social behavior. Marriage rates have fallen about 40% over 20 years, and fertility is the lowest in the OECD because expectations of future income disappeared. Middle-class consumption declines. Real retail growth dropped from about 4% historically to near 1%. Social conflict shifts from distribution to risk burden sharing. Policy direction is clear. Price defense must stop so markets function and risk disperses. Gradual adjustment is more stable than sudden collapse. Asset structure must shift toward financial assets and productive investment. Growth must be driven by productivity and income rather than asset inflation. In conclusion, what Korea faces is not a housing downturn, but a change in how status is determined. Attempts to restore prices only preserve the past. The future will reward productive participation rather than ownership. This change is normalization, not crisis. Understanding brings preparation, and preparation brings opportunity. I hope the government responds wisely. Thank you for watching Prof. NamYong Lee's column, Long.